Okay, right. So that should be the housekeeping done. As mentioned today, your panel will be, well, myself, obviously, and David Crosthwaite, our chief economist here at BCIS. So without further ado, I am going to hand over to you, David.
Thanks very much, Rich. Morning all. Quick run through the agenda for today, and we've got a pretty packed agenda, to be honest. I'm just hoping that we are going to get through all this. So first up, we'll do a little bit of setting the scene, looking at what was the backdrop to the budget, and then we'll tackle what was in the budget, with a particular focus, obviously, on our sector. Our assessment of what the government did, and probably major on what they didn't do, and then a summary of the impact, and then, as Rich says, we'll get to your questions, some of which have been pre-submitted. Okay, so if we set the scene, obviously there's been absolutely loads of coverage over the last week, and quite a bit of coverage before. Was it a shambolic budget, or is there some sort of cunning plan at work? Personally, I've never known a budget with so much pitch rolling beforehand. There's one thing that politicians seem to have learned since the Truss mini budget. There definitely can't be any surprises. Hence the raft of pre-budget briefings and leaks. On a positive note, and it's always good to have one, the Labour backbenchers seem to like the budget, and so do the markets, which is, I think, the main point of the budget, to be honest. It was a typical Labour Party tax and spend budget, although it's worth mentioning the level of tax rises in this and the previous budget are historic in terms of their size. The other thing that struck me was that, given the backloading with the tax rises, we do have to ask how realistic it is to have a raft of those tax rises coming in so close to the next election. So my suspicion is that they might have announced these things, but when we get to 28, 29, they could well come back and say, well, we're in a much better position than we thought we were. So we'll knock the tax rises on the head. A budget really for stability and or political survival, in my opinion, but certainly not a budget for growth. If we now take a look at the sort of latest economic metrics as we went into the budget, we've got consumer price inflation at 3.8%, gross domestic product growth at 0.1% quarter on quarter. The bank rate was at 4%, construction output growth at 0.1% quarter on quarter. The BCIS general building cost index at 1.5% quarter on quarter growth, and the BCIS tender price index at 0.7% quarter on quarter. Pretty unflattering numbers, particularly in terms of economic growth and construction output growth. So I'm sure you'll all agree. So if we now move on, one of the things that the government seems to be talking a lot about is investment for growth. And given that construction output is essentially a response to levels of investment in built assets, I thought it would be good to look at the current investment numbers, and these are up to quarter three of this year. And investment is measured by gross fixed capital formation, which is abbreviated as GFCF. It's an estimate of net capital expenditure by both the public and private sectors. And examples of capital expenditure include spending on plant and machinery, transport, equipment, software, new dwellings and other buildings, and major improvements to existing buildings and structures such as roads. So when governments mention investment, GFCF is what they're referring to. And if you look at the chart, you can really clearly see business investment, which is the blue line at the top, is by a large magnitude the biggest contributor of investment into our economy. and hence its importance in economic growth. So when business investment declines, there's likely to be a negative impact on GDP. Hence the desire to create an environment conducive to businesses continuing to invest. So has the budget done that? I'm personally not convinced, but we'll need to see how the GFCF numbers perform over the coming quarters. Despite the Chancellor suggesting that growth is their primary mission, this budget seemed to me to be a bit light on any measures to stimulate growth. Although, looking at government investment, which is the red line at the bottom, any measures, a bit like the uptick in government investment, which we can see towards the end of the series, it is obviously to be welcomed. So that was the value of investment across the whole economy. If we now look at the value of investment in built assets, which is the next chart, you can clearly see increasing investment levels in private dwellings, which is the sort of orange line in the middle. And the top line is investment in buildings and other structures. And the decline in the top line might be concerning if that downward trend continues. My hope is that could just be a blip related to the uncertainty in the lead up to the budget. But again, we'll need to monitor this to see if the budget has created the right environment to ensure continued investment in built assets. Let's now look at what actually was in the budget for the construction sector. So most investment in construction was actually announced in the spending review in the summer. So we were probably not really expecting too much from the budget in terms of construction measures. But here's a summary of the potential impacts that will affect our sector. Probably the biggest low light for me was the increases in the national living wage and the national minimum wage from April next year. That follows a similar above inflation increase in the last budget and is likely to make hiring more expensive. And again, the freeze on secondary threshold for employer national insurance contributions. That threshold won't rise with wage inflation during 2028 to 2031. There was the capping of annual tax-free employee pension contributions of £2,000 from 2029. All these are going to add to the cost of doing business, a bit like the increase in employers' national insurance, which came in earlier this year. So negative measures, those three bullet points. However, on the positive side, there's free training for apprenticeships under the age of 25 for SMEs, which was a positive. 13 billion confirmed for 7 mayoral strategic authorities to be invested in skills, business support and infrastructure. An additional £900 million of capital funding for the Lower Thames Crossing scheme, which will allow them to get to the construction stage and the tunnelling stage in particular, which was obviously good news. A new model of public-private partnerships was announced with public sector investment in NHS neighbourhood health centres. And a real positive for me was the continued commitment to spending review, infrastructure and housing funding, because that could quite easily have been cut. The government to produce a plan within 3 months that delivers on recommendations for nuclear regulation reform, which hopefully will spur that sector on, and 48 million of additional funding for planning capacity, which includes investment in 350 extra planners, which hopefully will address the backlog of planning applications. And finally, converging of the two landfill tax rates has been paused. Probably caveat that with for now. That would have added additional costs. So luckily that's been pushed down the road a bit. So I think all in all, a fairly underwhelming budget for construction. I do seem to recall I was saying that like this time last year, but
You said that every time, don't you, David?
I think we've now got time for a poll, based on what I've already said, and this is what we're going to measure your response over the presentation to see if I've made you even more depressed, but hopefully not.
I know my slight worry was the first poll was supposed to be a clean opinion, but I feel like you've already tried to set the tone here. But yeah, no, lovely. Thanks, David. So we are just going to pause for a second to ask this question for the first time. So you've heard what was in the budget. Now, from whichever position you're in or your organisation is in, the question here is: do you think the autumn budget has made it easier or harder to plan and price or cost work over the next coming year, or do you think it hasn't made any difference at all? So we're just going to give that a few seconds to everyone to answer. If it hasn't popped up on your screen yet, as I said, it will. If you just click on the little graph icon and you can ask the question there.
This is the way to check if people are actually awake.
Yeah, we've had one result so far.
Which means 600 other people are Wow, 418 voted. That's impressive.
It's going strongly so far, yeah.
So my facetious comments were unwarranted. So I apologise for that.
That's under 200 people not paying attention, which is great. Really good. So well done, David. You're. We'll see how well we do on the second poll.
That's right. Yeah.
Well, they're quite interesting so far.
So we can carry on. If you move on to.
Great. Well, I'm just about to.
Are you announcing the results?
Yeah, we are actually going to announce the current at the moment. I think so. Wow. Okay. So there we go. Yep, we are now published. So well, made no difference has only just taken it. A little bit harder is about the same. So we've got them both at 37% and 7%. A little bit easier. So I'm hoping some of the questions reflect that as we go through. Be really interesting to see people's opinions of why it has been made easier. Great. Okay, lovely. Well, thank you to 453 of you who contributed. Absolutely great. So if you, by the way, just in case you want to see these, if you click on the chart icon and see the poll, you can click on show the results now, so they are available. But yeah, almost locked horns on made no difference or a little bit harder. So yeah, looking forward to see if you've got any influence at all, David. Might just get exactly the same result afterwards, eh?
Yeah. Well, I mean, yeah. I mean, you don't have to be a rocket scientist to pick up that it was a difficult budget, I think, generally speaking, not just for our sector, but economy-wide. So that's one of the dangers of 24-hour news coverage. I was saying to someone the other day that when I was growing up, I remember just being concerned about the duty on cigarettes and alcohol when I was younger, because that's all they seem to report in the press. But nowadays, they don't report that at all. So.
No, mainly it's Freddo's. I see is what they use as a inflationary measure. Brilliant. Right. Okay. I'll pass back over to you now, David.
Okay. So some of you might recall this, but before the budget, we set out 8 key areas, actually based on a poll question that we carried out in the last webinar. And we thought it might be possible for the government to make a tangible difference to the sector with these 8 areas. And the biggest area, or the area with the most votes at that time, was taking action on business costs. And that was the area that attendees felt would make the biggest difference to our sector. I'll now run through those measures, because essentially we can sort of track the government's response to those measures, to see whether they actually listened. I'd be very surprised if they did. So if we move on to the next slide. So in terms of cost of doing business, we identified two areas which are essentially about the costs. So action on business costs was one, and pressure on resources and supply chain costs. So in terms of action on business costs, what we said was that the construction firms are really carrying the cost of rising wages, energy bills, insurance, and growing compliance requirements, from Building Safety Act duties to new environmental and information standards. So any move to ease those pressures, we thought could have an immediate impact on the sector. We were looking for changes to employer taxes, national insurance contributions, or business rates. So essentially rolling back what they'd introduced in April this year. I mean, it was a big ask. It was quite unlikely that they were going to do that. But with more than 100,000 construction businesses lost since the beginning of the decade, we thought stabilising costs could help restore confidence and support investment. So really, in terms of what we got from the budget actually went against what we'd hoped. It confirmed further above inflation increases to the national living wage and national minimum wage from April next year, and that's in addition to what happened in April of this year. So while intended to support younger workers, which is a positive, these changes raise employment costs at a time when contractors and consultants are already facing higher wage bills. So I'm not sure how that's going to work really in practice. The government also confirmed a freeze on the secondary threshold for employers' national insurance from 2028, and a cap on the tax-free employee pension contributions. Both of those measures will add to the long-term cost of hiring staff. So in terms of the verdict for that measure, none of that supports our call for easing business costs to stimulate confidence and investment. Actually, it ends up being quite the reverse. So talk about unintended consequences. So if we move on to the next measure, which was pressure on resources and supply chain costs, we said that while the direct cost of employing people sits under business expenditure, wider market pressures are contributing to labour being an increasingly significant cost driver on projects. Shortages in key trades, competition for specialist skills, and limited capacity are pushing labour rates higher. And recent ONS data, which you do have to take with a large caveat, I think, because it's based on the labour force survey, suggests that the construction workforce has fallen to a near 25-year low. And we were watching for any budget measures that might help ease these pressures through skills funding and training support. But particularly, we were looking for clarity on the long-term pipeline that ultimately gives firms confidence to actually invest in skills and labour. What we got actually was quite positive. A positive development for labour supply was free training for under 25s, apprenticeships in SMEs, which will obviously help over time. But the scale of that falls quite short of addressing the deeper workforce shortages. But I think we're on a positive note. You do have to take the positives. So ultimately, the verdict on that one was, while the funding for apprenticeships is welcome, there were no new interventions to ease materials-related pressures, to support import resilience or stabilise subcontractor availability. So we scored that one on amber, so slightly better than the previous measure, but still not a green. So if we move on to the next three areas, which relate to investment planning and pipelines. So one of the measures was improving access to finance, and we'd hoped that financing conditions would be improved, particularly for smaller developers and contractors. And we felt the budget was an ideal moment for the government to clarify their stated aims in terms of private finance models, or alternatively expand guarantee schemes that reduce borrowing risks for contractors. Clearer funding mechanisms could really help more projects move from the concept stage to delivery. And obviously we've got workloads that are remaining quite fragile at the moment, so any sort of measures to improve access to finance would have been helpful. What we got, despite a few references to the importance of private investment, the Chancellor didn't really outline concrete steps to improve finance conditions for developers or contractors. There were no new guarantee schemes, no clarity on the private finance mechanisms, and no targeted interventions for SME builders. Confirmation of a new model of PPPs being used on the NHS health centres was positive, but really didn't make up for the lack of wider explanation of how the government intends to proceed with private finance going forward. So the verdict on that one was an amber. The intention is clearly there, but there's not really enough detail yet for anyone to act on. Moving on to the next one, planning capacity and decision timelines. We'd hoped for renewed government focus on improving the planning system, given that capacity pressures remain a significant barrier to getting projects moving. So there was some positives. So we were watching for any budget commitments that would help strengthen planning teams, support digital tools and improve the consistency of decision making. Clearer approvals and faster approvals make a significant difference to project pipelines and cost confidence. So what we got, the government announced an additional 48 million over 3 years to improve planning capacity, including funding for approximately 350 new planners, which was a real positive, building on what they announced in the last budget. So the verdict on this one was a green. While, I mean, the caveat to that is obviously this measure won't resolve delays overnight, but it is one of the more tangible budget commitments for improving the delivery environment in our sector. So yeah, that was a good start.
I look how the one positive, David, come with a caveat.
Yeah, well, they always do. But it was a good start. And they've clearly recognised that the planning backlog is a major issue. So the concern is the immediate future, really. Okay, so if we move on to the next one, which was infrastructure commitments and pipeline visibility. We hope that the publication of the updated infrastructure pipeline would. My understanding was that it was going to be updated in real time, but obviously that doesn't appear to be the case. The next update is next month in January. The value to our sector at the moment of the pipeline is limited without clearer funding timetables, firmer investment signals. Lots of the projects in there don't have defined budgets. So it's something that we're looking. Like I said, my understanding was that it ultimately would be updated in real time, so it needs to be a live document. So we're hoping for greater visibility in terms of the budgets allocated and the costs of projects going forward. In terms of, that's what we wanted. In terms of what we got, there was a positive. The budget granted an additional almost 900 million for the Lower Thames Crossing project. Confirmed that a new model of PPPs will be used on NHS neighbourhood health centres, as I mentioned previously, and stated intent to improve nuclear regulation, which should all help with continued infrastructure investment. But the issue for me is, as I just mentioned, the visibility across the pipeline in terms of actual funding commitments and costing details for projects. So we'll wait until January next year to see for any more clarity on that one. The verdict on this was agreed. So despite the lack of clarity in the pipeline, at least we do have a pipeline. So we'll wait for the updates, but there were some positives in terms of commitment to the PPP program for the NHS health centres and also the additional funding for the Lower Thames Crossing project, so they can get on with the tunnelling. So the final three areas we looked at were housing standards and lastly carbon. So obviously, support for boosting housing delivery is one of the big issues in terms of the government hitting their target. So we thought that we hope that the budget might be a moment for the government to stimulate demand in the housing sector. I mean, obviously the latest figures show growth in net additions to the housing stock falling for the third year in a row, and the delivery in terms of the 1.5 million new homes in this parliament is massively off track. My estimates are that it'd be somewhere closer to 1 million, so a shortfall of 500,000 probably by the time of the next election. We essentially were looking for measures that would encourage people to buy, and that would drive developers to build. And support such as support for first-time buyers, or incentives that improve project viability. We were looking for something on those, but in terms of what we got from the budget, there were no measures announced to support demand, improve viability, or address barriers facing developers. So yeah, that was one area I did think that there was hope for some scope, but nothing materialised. So the verdict on that one was a red. There's nothing in the budget that will really move the dial in terms of residential building. I'm struggling to see how that market is going to pick up. But the other strange thing was that I thought it might be an opportunity for them to revisit their target, but they didn't take it. There is a paragraph in the budget in the Red Book stating that they are still committed to developing 1.5 million new homes. So I'm suspicious that they may start changing the metrics that they use to measure new homes delivered. So, but anyway, that's just my jaundiced view. So the next measure was the Future Home Standard and Future Building Standard, and we hoped that the standards themselves, while we didn't expect them to land in the budget, we were hoping that the government might actually provide some clarity on the timing and transitional arrangements for those standards. So we sort of understand that the Future Home Standards are expected before the end of the year, and the next 12 months will be a sort of transitional period. before they're enforced from the end of 2026. So we were watching for anything that might give us an indication of what would be involved in that. Given that the housing sector is already facing massively increased compliance costs with the building safety levy and etc. So unfortunately, in terms of what we got from the budget, there were no updates on either of the standards. So the verdict on that was a red, and the wait continues. I'm assuming that there'll probably be a raft of announcements in the new year when we're all back from the break. Signals on whole life carbon and support for low carbon materials. We'd hoped that there'd be some mention. We weren't expecting a mandate for whole life carbon reporting, but we were watching for support for low carbon products, reuse, increased recycling efforts. But unfortunately, there were no explicit commitments on whole life carbon reporting. There was a relevant environmental policy shift, which came through the decision not to converge the landfill taxes, and which would have, I mean, if they had combined them, that would have increased internal inert waste disposal costs. And the government, I think, clearly recognised industry concerns that were raised during consultation about the potential cost impacts. Yeah, beyond that, there was no real new incentives targeting low carbon in the budget. So, given that the landfill taxes weren't combined, our verdict on that was an amber, so a sort of mixed bag. So, in summary, those areas, the key areas that you essentially identified in the last webinar for government action, we scored, as you can see on this slide. So we've got 2 greens, which is good, but predominantly we've got yellows and reds, and I guess in school reporting parlance, that equates to could have done better, I think.
See me after class.
So that was a quick run through. I'm conscious that that's used up quite a lot of time, but we did think it was important that some of these things were buried in the red book, so we sort of had to dig around to find them. But yeah, I mean, generally speaking, could have done better for our sector.
Great, thanks, David. Brilliant. Okay, so as I said, we've kind of covered all of the key areas for the government action now. So we are going to just pause again here to ask the question for a second time. So the poll is now published. Hopefully you can see that. So basically, you've heard David's assessment of what was in the budget. Do you think it has made it easier or harder to plan or price of cost work over the coming year, or do you think it hasn't made any difference at all? Again, we're just going to give it a few seconds just while we let everyone put their vote in. You should be able to watch this live, but if it hasn't come up on your screen, it is accessible via the little graph icon. Also, just while we're doing that, just a polite reminder as well that all poll questions are on there to answer now, so we won't publish the other ones until afterwards like normal, to give everyone a chance just to answer them right up to the end of the session. I'm just going to have a quick check on where we're looking. Okay, nearly 400 already. We'll just give it a few more seconds. Hopefully that'll be there. Well, unless we're going to get any severe changes in the remaining 100, about 400 people have voted. We're pleased to hear, David, we've now moved to 47% for a little bit harder. So that's a 10% increase.
My job was is done. Yeah.
If you had one objective.
That was it, to depress people even further.
So interestingly, it made no difference at all, as only just reduced from 37 to 35. A little bit easier, 7 to 6%, but yeah, a little bit harder is now at a whopping 47%. I think we also very much need to acknowledge the 6% that said much harder. You know, as all jokes aside, it is very much a reflection on the market we're operating in at the moment.
No, absolutely. I mean, you know, I don't want to depress people too much. I mean, the one really positive takeaway was I was fearful that the government might use the budget as an excuse to start cutting capital spending. So, you know, cancelling projects that they'd already committed to in the pipeline. So I was quite fearful of that. So that actually didn't happen. So that was a bit of a positive. So.
Good positive. Okay, great. Well, actually, just before we move on to the pre-submitted questions, we have had one through that I think we should probably address sort of head on, really, David, as well, probably vital to the whole construction industry. But so just in your opinion, did the Chancellor's announcement of 1p off beer in the 2024 budget have any impact on construction productivity?
Oh, absolutely. I'm sure productivity will go through the roof as a result of that. Yeah.
I wonder if there's an index we could do on the future quarterly sessions. Great, that's a brilliant question. Okay, lovely. Right, so we are.
Who was that from? You probably can't identify them, but
yeah, well, no, we'll keep it confidential. But lovely. Right, so we are just going to just pop through onto the poll questions here now. So once we are done, so yeah. Britain appears to be in a fiscal doom loop, which I can assure you is going to be a regular word used by David in 2026. So with appears to be in a fiscal doom loop with increases in taxes to plug the deficit, having the effect of depressing growth and government revenues. How can we escape this cycle?
I absolutely love this question, and I do love the term doom loop. I will probably be my term for 2026. I mean, the really simple answer to this is change the government. The budget was essentially a typical Labour spend and tax budget, with all the implications that approach brings. And I think one of the things that I think surprised a lot of people is that this was a typical Labour budget, and because they haven't been in power for so long, I think generally people have forgotten that this is what they do. But having said that, I think that there are two major shocks to our economy that we have to consider. So if you go back to 2019, the economy was just recovering from the effects of the financial crisis. Leading into 2020, we had the pandemic hit. So our economy's got serious legacy issues that are negatively impacting the current state of our economy now. And I think it amazes me that the Chancellor seemed to blame everything else but the pandemic. And it's becoming increasingly clear that recovery from the economic impacts of the pandemic will probably take a decade or more to fully unwind. The lost years of the pandemic period disrupted supply chains, capacity, investment decisions, and labour dynamics in ways that continue to shape the economy's performance today. I mean, many of the constraints we're still facing are not short-term market fluctuations that you see after a typical recession, but real structural problems as a result of the long tail of those shocks working their way through the system. The unfortunate piece to this is that there's no easy answer. So, you know, in terms of the question, how can we escape this cycle? I think we just need time for these things to work through. To be honest, I'm not sure, you know, the Labour Party or the Tories, I don't think there'd be major differences between them in terms of tackling this. I think it is just a question of time. But yeah, great question.
Yeah, absolutely. And for the first time in this session, I'm also just going to use my default line of some of the opinions presented in this webinar are of David's and not necessarily BCIS's.
Of course, yeah. I should have done that. I apologize. I forgot. Yeah.
But no, brilliant. It is a really, a fundamental question. Actually, the next one I'm personally quite interested in your thoughts here, David. But, are house prices still going up despite pressure on house building margins caused by levies?
Yes, they are, but only marginally. I mean, house price growth has slowed significantly over the last year. And in real terms, price growth is falling behind CPI inflation, so wider economy inflation. And I think that's a warning sign, which is stalling developers. I think so. There is still growth. House prices are growing, but nowhere near the levels that we've seen in the recent past. And as I said, in real terms, they're not keeping up with inflation. So until that changes significantly, I don't think the housing market's going to pick up too much.
Interesting. I mean, it did feel at one point nothing would slow down house price increases, but it does seem to be catching up again, doesn't it?
Yeah, I think a lot of this was obviously, again, driven by the pandemic. We had the race for space, which really boosted house price growth. That really has subdued significantly now. And yeah, I mean, it's not, I'm struggling to think of a positive to stimulate housing demand at the moment. There just isn't that drive generally across the economy. And with first-time buyers stalled, first-time buyers market stalled, and the much discussed mansion tax coming in, that's likely to hit the top end of the market. So you've got these unintended consequences from governments tinkering with what should essentially be free market. There are always consequences from governments tinkering with, particularly with housing. So yeah, it's going to be a struggle, I think.
I suppose an increase of houses now at 1.999 million rather than 2 billion as well, supposedly.
Well, the other thing to consider, I mean, in all seriousness, is who's going to be valuing all these properties over £2 million? And like you say, I mean, most owners will be putting pressure on the valuers to have their value come in at 1.999 and nowhere near 2. So, yeah, in a sector that's struggling, I mean, particularly in white collar construction consultancies, for instance, there are shortages of staff there. So, I mean, I just don't know how the industry is going to respond to increased capacity for valuers. So, yeah, it's another thing to consider.
Definitely. Great, thank you. Okay, on to our next one. So, what financial impact have the troubles, i.e. skill shortage, change rules within the building control profession to meet the demands of the industry had?
Yeah, I mean, increased regulation coupled with a lack of capacity has resulted in significant impacts for the sector, both in terms of time for approval, building control approval, and sign off. And the impacts aren't just on the ground. The impacts are being felt at both consultant and contractor level, and are acting as a brake on demand. I mean, obviously, a lot of the building control approval process is not strictly all done by the public sector anymore. So there are private sector organisations involved. One of them ceased trading a few months ago, which obviously had massive impacts on the gateway process for the Building Safety Act regulations. So it has had serious impacts. I mean, obviously, the building safety regulations are important and critical. But again, it's government tinkering in a market that has unintended consequences in terms of putting a brake on demand, and fundamentally also increasing costs, because the costs to get through the approval processes are borne by increased design costs, increased consultancy costs. So it's not just about increased cost to deliver, it's also about increased cost of compliance. So yeah, it's had a major impact.
Brilliant. Actually, we've actually just had a question in, I think, kind of complements this really well. So are there any measures for accelerating compliance within the Building Safety Act? Gateway 2 approvals of building control, for example. It's saying here that I saw some progress had been reported this week, and the BSR is becoming an independent public body in January. Yeah,
that's true. They've actually stated, and I'm not sure how realistic this is, but they've stated that they'll have cleared the backlog by the end of January, based on the progress they've made over the last few months. So yeah, it remains to be seen whether that's a real thing or just some made-up press release. So yeah, there is some positive movement in terms of numbers. But yeah, I think the proof of the pudding will be in the eating. But yeah, the BSR is moving from, it's currently administered by the Health and Safety Executive. So it's moving into a standalone organisation, which hopefully, if it's properly staffed, should make a difference. So there's time taken to. I mean, the other thing is, it's not just about Gateway 2. It's obviously subsequent gateways 3 and 4, where there are likely to be difficulties as well.
Yeah,
it's an ongoing problem.
Not going to go away anytime soon, I don't feel. But okay, lovely. Right. So David, I'll pass back over to you for the summary.
Okay. So I mean, obviously, I can feel that the sentiment has changed a little bit given the two results to the 2 poll questions at the start and towards the end of the presentation. I mean, the autumn budget provided a few supportive measures, as we sort of touched on. Planning capacities improved, apprenticeship funding, and the restraint on the landfill tax reform. But it did really stop short of delivering any substantive interventions needed to improve the construction environment, or fundamentally, which is, I think, the really important issue, not just for our sector, but across the economy, reduce business costs. It wasn't really a budget for growth, in my opinion, or that there is some cause for optimism in the investment numbers that we looked at right at the start. On the plus side, like I said, it appears that no capital spending promised in the spending review from the summer has been cancelled. But on the negative side, increased cost to do business are likely to be inflationary and will hit hiring going forward. Our panels, and we had a panel last week post budget, suggest that output growth might struggle next year, but they highlighted the prospects in both public housing and public non-housing seem promising, and they expect public sector work to take precedence over private sector output, given the challenging conditions for businesses. And I do think we started to see that in the investment slides, in the investment charts that I presented at the start. So we had public sector investment with an uptick. I mean, the concern for me was that business investment was down, but hopefully that's just a blip. So moving on to the final slide. I mean, where does this leave firms working in our sector? I mean, I think the economic backdrop is still difficult for construction. We've got clients and investors adopting a wait and see stance and hoping for fiscal clarity from government or improved financial conditions. But the point at which that comes keeps being pushed back. I mean, I am fairly positive that the Bank of England will reduce the base rate later this month. And I think that's going to be on the back of what was in the budget, because I think I think they realise that the economy does need some stimulus. But for our sector, we're essentially being squeezed from both sides. It is a difficult climate, but opportunities do exist. I mean, clients who proceed with investment at the moment can secure competitive tenders. Contractors who manage risk and productivity and capacity can maintain resilience and actually even gain market share. The coming months will be shaped not only by the outcome of the budget, but perhaps more decisively by how our industry decides to respond. So firms that approach risk with discipline, rely on data rather than reacting to headlines in the press, maintain an open dialogue with clients, and focus on the medium to long term rather than the short term, will probably do best when conditions do improve. I mean, looking to next year, I mean, I've been waiting for the uptick to happen for the last couple of years, but I do think there's cautious optimism. We've got greater clarity on the pipeline. Hopefully there'll be some news on the financing models for private finance. And we've got policy commitments that hopefully will unlock investment. So I think finally, if confidence returns, and that's a big if, given what's happened over the last couple of months, I think next year could begin to deliver the uplift that our sector's been waiting for. But I am conscious that over the last few webinars, I have been saying that, and I've been waiting for the uptick, and it hasn't happened. So until it does, I'm slightly sceptical.
Brilliant, lovely. Thank you, David. Right, okay. So I have tried to integrate quite a few questions during the session. We've got a couple of bits here we'll run through. Apologies if I've missed any. As I said, we will pick these up in a post QA, but we're trying to kind of keep them in line with the content. So I like to answer in one line. Isn't it a bit too early to say whether the markets really are okay with the budget? Are you being a bit blinkered with our expectations from the budget? And so how much to be done across the entire economy? If there was one thing you could implement that could improve the construction sector performance, what would it be?
Yeah, you're right. Good question. Yeah, I mean, I think that's one of the issues with the environment that we inhabit at the moment. 24-hour news cycle, people pick everything apart to assess what the implications might be, and people want news, now. They don't want to wait and see what the impacts might be. But absolutely, you make a good point. And I sort of touched on that when I had the investment charts up, that we do need to monitor these things over subsequent quarters to see what the impact will be. I think I tried to present a picture that was accurate rather than based on what we currently know. So yeah, I mean, most of this is our interpretation of what was announced in the budget and what the potential impacts might be. It'll be interesting to see over the next few quarters how that actually pans out. What was the last bit of the question?
Yeah, sorry, I asked. I should have split those up a little bit more. So yeah, no, I really like this one. So if there was one thing you could implement that could improve the construction sector performance, what would it be?
Yeah, that's a really good question.
Do we go back to beer now, David, again, or what do you think?
Yeah, I mean, what I would have done, it's easy to say this in hindsight, but in the first budget, I would have, instead of a massive injection into public services, which did need some investment, I would have targeted all that, not all of that, but say half of that money, so £20 billion into capital projects. So that would have pushed projects like Lower Thames Crossing a bit quicker. So I think at the moment, what we tend to be, most things are stalled, and what we need is a real commitment from the government in terms of cash, I'm afraid. But the Labour Party have different priorities. So public services are, their number one priority. If I was Chancellor, I would have invested more in capital spending.
Brilliant. Okay, great. I think we probably covered all of the questions now. As I said, just to repeat myself again, we will absolutely review these and come back to you. So you will receive a response to your question. Hopefully we've covered it all. So on that, it feels a good time to wrap up, I think. So I'm just going to do one last shameless plug for our next webinar. So when David will be back in January to share his highlights of the BCIS 5-year forecast and lead us all on his whistle-stop tour of our forecasting team's expectations for output, building costs and tender prices. So I hope you have a great Christmas, David. Otherwise, we're going to have another gloom, I think. So hopefully come back full of positivity.
Yeah, you too. Happy New Year.
But brilliant. Just thank you all for joining. This is our last webinar of the year. So I hope everyone has a peaceful and restful break. And we shall see you all in 2026.